Hi, this is Randy Finney with the Right Side of the Chart, and this is an early session update for Friday, January 12th, 2024. In this video, I'm kind of going to jump all over the place a little bit, and I think that's a good thing because, as I often preach, the virtues of being diversified, don't put all your eggs in one basket, is every bit as important in active trading, swing trading, trend trading, as it is in long-term investing. Some people do focus on one thing or the other. You've got Bitcoin traders, you've got stock futures traders, those that trade maybe Apple or, a particular stock or sector. Some people, that's all they may do. But personally, I like to, um, you know, uh, trade at pretty much at any given point in time. There are times I might, go to cash or stop altogether on vacation, stuff like that. But for the most part, if I'm actively engaged in the markets, I like to have a mix of different trades, and ideally, not just different stocks or sectors, but different asset classes if possible. In other words, stocks are one asset class, bonds are another, commodities are yet another. And within the commodities arena, you can be super diversified because gold has no correlation to wheat and things like that. So, all right, let me dive into the charts. I'm going to start out here with the markets just to kind of reiterate. I don't want to spend a lot of time. I've covered this in depth, and I always do. I put most of my analysis, the majority goes to the stock market because that's number one. That's what most people trade or invest in. Just about anybody listening to my voice, or everybody listening to my voice, has had money in the stock market, has 401ks. And it's also, where the market goes. So ultimately will go the economy, especially on the big moves. And so it's important maybe to make, for those trying to figure out, what I might want to buy that second home this year or to start a business. And so I'll sometimes quite often speak to my longer term economic outlook and stock market outlook. Again, predicting a 40+% drop in the S&P, in the Nasdaq 100 obviously equates with a bear market, and obviously that's going to equate with a slowdown in the economy, maybe even a hard break, if you will, instead of a soft landing. So we'll see, right or wrong. And this is where I'm going to go kind of all over the place here. Lately I've been posting more and more active trading setups, and this is what this site is about. It's about swing trading, and I often use different nuances, different little terms within swing trading. There's active swing traders, I'll say, and those are the ones like me that will, get in and out. Often end up day trading. I mean, by definition, people ask me what I do. I'm not a day trader. I'm typically a swing trader, but I make thousands of day trades a year, and a day trade by definition is when you're in and out of the security in the same day. And again, that's just a function of the charts. I'm an opportunist. If I see a day trading opportunity where I can make 1%, 2, 3% on something, sometimes even less than 1%, I'll do it. Typically use leverage. It makes it worthwhile. If you're trading, any of the futures contracts, they're highly leveraged to begin with. So just a handful of contracts, depending on, again, what you're trading, what your portfolio size is. You can do very well just skimming those, 1, 2, 3% moves a couple times a week. Do the math on it. You make, let's just say, let's keep it conservative. Say you make 3% a week times, 4.3 weeks in a month, or 52 weeks in the year. And so you can do the math there. It adds up. Okay, so let's just start out here with QQQ. No change, and you can see I've been looking and highlighting a lot on the 15-minute charts. This is a function of, even though the VIX is relatively low, we've seen some pretty decent volatility coming into the beginning of the year. And so again, where I'm going with this is a function of these more frequent trades that I'm giving you, pullback opportunities, bounce opportunities, pullbacks to support on not just the markets but everything else, is a function of that. It's been this market's been pretty conducive to active trading, and so far, QQQ is still. It's also, I considered, a long-term trend swing short trade with multiple targets I speak to all the time here. But again, when the odds are good for a bounce, like they were here, remember, we pivoted long right there, covered shorts, made it clear that, came into the year short right there, and then also, played some long bounces there, came into 2022 short, came into 2023 bullish and long, right off the lows with the big fangs. So that's and those are longer term. Well, those are trades that we milked the initial run, got out, and got back in here. But this is longer term swing trading. These moves here, and nobody bats 1,000, but we did very well on the way down. Pretty much milking most of, if not all, in some cases, damn near all of these swings, these major swings, going long and short. While all along, I acknowledge that's not for everybody. Some people don't have the skill sets, the time, or the inclination. A lot of folks listen to my voice probably work another job. Some are probably retired and don't want to be in front of the computer, 10 hours a day like I am often. And so they might have just, held off and then, focused on these longer term targets that I laid out here, on the weekly chart. And so that's more of this is the realm of the trend trader right here. This is the realm of a swing and trend trader. And then I step down. That's a daily chart, guys. What I'm doing, I click from, if I didn't say it, I'm sorry, weekly chart over here, down to a daily. And then you can go down, even get a little more granular, go down to the 60-minute chart. And then lately I've been posting a lot of 15-minute charts. So 15-minute charts can be in, out, in, out, in, out. And me personally, I'm often looking at 5-minute charts, 1-minute charts, but I just can't post all those little micro squiggle trading opportunities, all that. Your inbox will be inundated. So generally, I try to get the swing trade ideas out. But okay, so we're just going to start here on QQQ. No change. What we had is at the 15-minute chart, we had a divergent high here. We ran down, put in a divergent low. That was the reason to get long, trade a bounce. At a divergent high, we broke down recently. And you can see, and these are the same lines that have been on the chart. We had a back test of that downtrend line right there that was taken out here. They popped it, ran up, back tested it, and there was some price support there, rallied off there, and we put in an ever so slightly higher high, and we still have the negative divergence. So nothing in my near term and intermediate term, especially my longer term outlook, nothing's changed there. So that's still down. And then again, I'll get to in a minute the things that if you do share the same mindset and positioning I do, short the Qs right now as more of a swing trade for the next leg down, then it makes sense, I think, to have some, like what I refer to as indirect hedges. And just to clarify, what I consider a direct hedge, if you're an investor and you have a portfolio of blue chip stocks or tech stocks, whatever it is, S&P fund, Nasdaq 100, you don't want to sell for tax purposes and realize gains. To hedge up, if you're long the S&P 500, let's say, or mostly stocks that mirror that, then you buy puts on the S&P 500, or if you're tech heavy, you'd want to buy probably puts on the Nasdaq 100, and that's a direct hedge. So if your portfolio goes down 10%, those puts, if you calculated the right amount to offset, it's going to offset the losses, and that's a direct hedge. Direct hedge is typically you go nowhere, and by definition, a direct hedge should be, of course, directly tracking the security, move inversely with the security that you're trying to hedge, and also, move up proportionally to how much your other security goes down. So I like indirect hedges. I don't believe, me, I'll just pull the trigger. If I think something's going to drop, I don't want to hedge up. I'll just sell it. Usually trade futures there's huge tax benefits to trading futures over individual stocks. It's one reason I do it. And, like I said, I think something's going to drop to me. I'll either sell it outright or take indirect hedges. And so that's what I spoke to yesterday with gold and silver and all that. And as I posted today, the gold and silver longs were yesterday about 1 p.m., I think, give or take. And that was right here. And then QQQ over that period of time into this morning right here moved up. That's about, now it's showing about 1%. I think it was even less than that where I measured from where we took that trade. But then I've always mentioned over the years, typically, not always, but typically when I'm long, bullish on gold and silver, I'll go with silver because you get more bang for your buck. The same way you get more bang for your buck going long GDX than gold. So silver, actually, we took it here right off the lows yesterday, and better than 4%. That doesn't always work out that way. There's nothing to say that they both can't go down, but so far so good. And then while I'm here, I'll just talk on that. So silver hit to the button. I got these levels out to you in advance, and we were coming up to that one. And even yesterday, no, I didn't give you. I gave you the silver futures because I wanted to get those trades out. If you're wondering, why, if I see something that's timely and I want to jump on it, or I think it's a timely, thing, I'm not going to spend, because it can take, man, well over half an hour to start annotating and marking up charts and composing my thoughts. I don't use AI. I don't have anything write my posts. I have to, do that myself. And so, I don't want to, if I think something's about to move, silver was at support. This is where we were when I got the post out to you yesterday afternoon right here. And now, boom. So this morning, as we're coming up, it's at 2157. Remember, these are actual resistance levels. You always want to sell, if that is your plan, a little shy of that. We had a high of 2154. 3 cents on a 21 and change security, close enough for government work, and we reverse. So that's where an active trader can book profits, gain a 1% pullback. If you trade SI, silver futures, like I do, I don't have to tell you how much money that puts in your pocket, just a single contract, even if you were just trading one contract there, a 1% move. But, so that's that. This is that chart I got out to you this morning. You can see we were coming up, still had time to a little bit of a room to run. We were 10 cents shy of that level. And then, that's the plan. Came a reaction. If I didn't think a reaction was likely, I wouldn't put that or say that. And then, as of now, I still, plan to cover the, reverse, sold and cover and then go back long again. But again, there's not an infinite number of variables. I mean, technically there are almost in the stock market, or any even one security, but there's enough variables in silver alone and gold. One of which, not, of course, is the currencies, the U.S. dollar and the euro. But let me go back to the chart there. So that's silver. There's the pullback. We may make it all the way back here, but typically if you're bullish on something, this is a breakout of a bullish falling wedge. Remember, we had this divergent low here. And it doesn't say it, but that's a divergent low right there, just like you had a divergent low right there, and that's the pop so far. So that's a breakout, and so that's objective level 1. And again, if if I have had resistance there, resistance once broken becomes support. So if your support's 2021, the same logic where you want to sell a little shy of resistance on a long, if you plan to go into a pullback on support after breakout, you might not want to try to hold out and get greedy and nail it at 2124. You'd want to step in just a hair early, about pretty much where we hit so far. If it fails, then that fails. We're probably going to go, if that level gives way, we could be coming down for a back test, or maybe this was a failed breakout. As of now, it looks good. Again, I'm going to get into the charts here in a second. And so I still, gave you some additional targets. I think they'll be hit. And so there's silver futures to the button. I haven't modified this. These were the targets laid out yesterday. We went long even before the, right off the lows. And so nice run. And there it is. So the pullback, and remember, this was one of the targets. I had arrow breaks here yesterday in the trade idea arrow break at that trend line there. These are arrow breaks to note where a reaction is likely. We punched through there. And this is the first one where I think we'd had a tradable pullback. That's why I got it out to you. And so far it was good. It was, whatever, better than 1%, and close to that support there. So that's that. Probably step in, buyers probably step in and run it up to the next target. Okay, and this is what gold looks like, GLD. Of course, I got you the futures out yesterday, but if you trade the ETFs, no problem. There's the it was support. You can see that previous reaction low. You have a gap right there with the top right there. Another reaction, another gap. These are reasons that that's a support level. And so gold had fallen to support with positive divergence. So, this is simple stuff. It's not always so easy. I'm not trying to make it seem like it's super easy and it works 100% of the time, but pretty simple. Divergent low, you rally, divergent high, correction, no low. Maybe, yeah, actually. Yeah, you had equal lows there on the RSI with lower lows in price. That was a divergent low, rally, divergent high, correction. Simple stuff, right? All right. GDX, I'm going to give you that. Again, this is swing trade. I roll back as long. These are old annotations. These are trades I got out to you in the past. Let's just, again, look at it. Divergent low. It was right here. That's as far as I can scroll back. Rally. Divergent high. So we put in a high. Almost an ever so slightly higher high. Even if it was an equal high, it would have still been divergence because the indicators were moving lower. Divergent high, correction, divergent low, rally, divergent high, correction, divergent low, rally. It's almost too easy, right? But most people don't do this and don't take these trades because they don't believe in it. And again, these divergence aren't necessarily they're not buy or sell signals. They're conditions. They are conditions that momentum for that current trend is waning, and they indicate, not guarantee, but indicate a trend reversal is likely. But then when you can line up bullish or bearish divergences with pullbacks to support, all the better. And that's what it's a big part of my trading style. So that's it. So that was, again, we were right at the lows yesterday. If you took it, so far it's about a 6% pop in GDX. As I often say, my logic is like this. I'm either going to be right or wrong on any trade. Right? That's just a given. If I'm going to be right, I want to get paid for it and get paid the most I can pay. It's like, imagine if you go, you're looking for a new job and somebody's offering you, 100,000 at one job offer, and the next company offers you 200,000 for the same job. What are you going to take? All other things being equal, obviously. So it's the same way here. Gold, I will trade it at times. Typically, silver is my preferred proxy, or GDX and accounts that I don't use futures. Or for some reason, whatever reason, sometimes I'll favor the miners. But there's gold popped from yesterday's low. I'm just measuring it for you here. I say this often, but it bears repeating. So 2.41%. But if you're going to get the move on gold right, GDX is simply going to move up in a multiplier of gold. From my experience, it's at least 2. And it cuts both ways. Keep in mind, if you're wrong and gold went down, GDX usually falls more. But there it is. So, 2.5 versus, so far 6% pop in GDX. But right into resistance, there's a gap. So just like silver and gold, got out. If you expect gold and silver to pull back, then by that logic, you would expect, and they did, the miners to pull back. And then ultimately now, if they pop today's highs, then they should backfill that gap. But GDX is unlikely to do this or this unless gold and silver rallying too. So there it is, positive divergence, divergent low, just like we had here, divergent high, wash, rinse, repeat. You can go back as far as you want on here and see this is pretty much, the setups and trading history of GDX. Not that I took every one of these or posted every one of these, but a good part of them. And then there is, I'm going to speak to let's just roll into that now since I'm on the metals, then I'll get to currencies. Somebody asked me today, they talked about gold. Gold is putting in, let me turn off all the lines. There's this massive, this is GLD, the ETF, spot gold's similar, but just look at this massive top right here. And most market participants are very bullish. I've been bullish longer term on gold, been overall, calling for a bull market way back when, since before this one started back in, it was late 2015, I think, was it? Yeah, I'll go back in a second on the weekly. But a lot of folks calling for this to break out and run. And I can easily see that possibility. It's going to depend largely, if not exclusively, on where the dollar goes. Now, I don't want to get into it too deep right now. I'm just going to say I'm not an expert on foreign currencies. I will chart it. I trade it. I've put a high weighting in my analysis on what the euro and US dollar is doing because of that strong inverse correlation from gold. I know there's always new folks coming to the site, so let me just say very clearly why that is. And it's I'm not going to use the word immutable. There are certain correlations that are immutable, such as the price of treasury bonds and their interest rates. That cannot, does not, will not change. It's mathematics that control that inverse relationship on the price of a bond and its interest rate. However, on gold, if you froze supply and demand, meaning it was equal, there were as many buyers as sellers at any one point, and you stripped out that variable, then there is at that point, there's an immutable correlation between the US dollar and the price of gold. And it's simple because gold, at least here in the US, or you may live somewhere else around the world and you're trading it in your currencies. But if you're buying this ETF, GLD, or a bar gold or a gold coin from Costco, whatever it is, that gold is priced in US dollars. So if the dollar drops in value, is falling in value, it's going to take more dollars to buy 1 ounce of gold. So the price of gold is going to go up. Likewise, when the dollar is strong and rising, it's taking fewer dollars to buy an ounce of gold. So that's why I put so much emphasis in making sure or trying to align. If I'm bullish or bearish on gold based on the charts, I'm going to look at the euro, US dollar, see if they confirm. And I always say the euro because it's the biggest component of the dollar index. It's basically the inverse of the dollar. And so that will either help to confirm or refute. And if my analysis is refuted, I kind of take a step back and maybe I'm a little less bullish, or I might just decide either to not just pass on the trade altogether or maybe not take a very large position. But when the stars and moon align, when I can make a very bullish case on the euro US dollar pair, meaning the bearish bet on the dollar's going to drop and gold looks bullish, then yeah, that's where I'll kind of overweight that position. Okay, let's talk about that. So this is a busy board here. You go back to the weekly chart and you can see this is kind of the longer term history back to 0405. Big bull market in gold that ended right. I'm trying to get my arrow tool. There it is. Blow off top right there. Went parabolic towards the end. Had a bear market. We were in this trading range, its basing pattern for a couple of years, actually more than a couple of years, several years. You can see it down here, really 2013 all the way to, we really broke out. This was huge for me. It always was. I was talking about back then, 130 was massive resistance because it defined the top of that range. And so that's when gold took it out and let loose. So that would be comparable, a breakout above this level now, all other things being equal. Now let's talk about all other things being equal. First of all, gold put in a divergent low here. That was the bottom, the end of the bear market. Very clear positive divergence on this very significant weekly chart. Stayed in a trading, it was the low. We started making higher lows, but yet not higher high, equal highs till we broke out there. And that last overbought reading is what did the trick, sent us up, boom. And then here's a great example. No divergence here. We started to have divergence at that point, but we just burned through it up until we got to this point right here. And then you had the divergent high, as I said, only on the RSI. That gave us that correction. We were bullish and long and strong gold going up to there, and mentioned getting out and turning around, closing out long-term positions. This was on the site personally and recommended to go short. Just close all long-term positions, go short. That was a major high, major resistance. And so since then, that's it. Gold's been in this big range, and a lot of eyes are watching that level for a breakout. Now, the problem I have with that, I would be, and it is, I'll try to recognize my biases, especially confirmation bias. That's one of the worst things that can affect a trader or an investor, is confirmation bias. That's basically hearing what you want to hear that supports your case and going with that, and then dismissing everything else that goes against the case that you're trying to make to be bullish or bearish. And so where I'm going with that is the problem that I have with gold, and this could be taken out. There's no guarantees that these divergences have to play out, but I've been talking about it for a while. There is big negative divergence. It's been building for a while on the weekly chart on gold. GLD or even spot gold, look at it. And so you have these three equal high. I call this one ADH. That means almost divergent high because we fell a little shy. But this most recent thrust up, they're pretty much equal highs there. and you can see. So you can draw it two ways. You can draw the divergence right here if you wanted, if you don't want to use that big line there, which it is there, or you can draw these, the indicators here, making lower highs on this new marginal new high over that previous high right there. So what I've said for years, if you followed me for a while, you've heard me say it dozens, if not hundreds of times, breakouts that occur to new highs that occur with overbought conditions and or negative divergence, especially with both, I say with both, negative divergence and coming off overbought conditions, have a much higher failure rate. In fact, it's considerable. It's not 51%, it's much higher. I'd say probably 70 to 80% or more of those fail. And that means, what does it mean? Well, this is important too. And this is where I try to be very careful on how I'm talking. Put it in perspective with the time frame. This is a multi-year, big, sloppy, well, the top is well-defined, multi-year sideways trading range, really bounded by about 157 other than this brief spike below. And the highs here, which is about 200 or so. What is that? Yeah, 195. That trading range, since we entered it back here, that was in 2020 right there, right? You can see the lines right here. So now we're talking a range that spans over 3 years at this point. And so, the failure, if we pop a breakout, could easily last weeks, possibly even a couple months until it fails. Now, there's two ways to do this. Number one, if you are bullish on gold and you believe the breakout will stick, and I'm kind of, I don't have a strong opinion, but you take it on face value. Sometimes you don't overthink these things, or you end up with paralysis by analysis. You take a breakout on face value, and simple. If it fails, it fails. So you might have an uptrend line here, and a failure wouldn't be the first tick down to me below 195. The way these things work is usually the nefarious forces, the powers that be, whatever you want to call it, will run it down and a little bit in to kind of shake out some weak-handed longs, suck in some short sellers that think it, so you want to give it a little room. And why not? If you're looking at, trading a breakout above this level, that's not an active trader. That's not a day trade. That's not a short-term swing trade. That's a position trade that you think gold's broke out of a multi-year trading range, which again was not too far off those 2011 highs either. That's just a massive top. And so that would project a lot higher. I don't even have the numbers on the screen here. So my point is, if you took it, you could allow yourself, maybe, you can take a full position, you could take a half position and then try to position on a pullback or a back test if you think that's going to happen. But, your stop would be commensurate or in line with how long you plan to hold gold, how far you think it can go. Because if you're looking at a breakout and then maybe a 40% run in gold, you can give yourself a 10% stop loss if you took the breakout at 195. Instead of stop loss 10% below, then you're giving yourself a nice 4-to-1 risk-reward ratio. And that's probably going to be out of the reach of any stop rate or a little pullback there. So that's it. I wanted to talk on that. And now the one more thing I wanted to talk on too, again, this is long-term stuff, and I'm addressing the question of the member of the site that asked about that, my thoughts on that. Let's go over here to gold, and this is a chart of gold, continuous contract on futures, and you can see the same thing here. You can see there's a little spike up right here. Unfortunately, I can't take the scroll wheel on my mouse like I can on those other charts at TC2000. This is stock charts. I can't zoom in. So forgive me for that. So you have to go back here, and it's clunky. You have to change the time frame. But just follow me on that. There was a little spike up there. So you have technically this big divergent high. You can see the same negative divergence here. Let me change my color tool, and you can see it a little bit better. Color up blue. All right, so there it is. So that's a little divergent high there. Same story here. And what I wanted to show you down here is the US dollar. I've talked about this many times in the past. Typically a falling dollar. See this bull market in gold right here, the previous bull market, there's a strong run up there, and you can see at the time the dollar peaked here, was falling in another rally, but it continued to fall. So overall that trend was down, and then the dollar bottomed about right here, right when gold stopped. So what I'm doing is just showing you, instead of, don't always, I've learned this a long time ago, don't always take what people say on face value. There's a lot of so-called experts out there. I'm not trying to say I'm an expert on anything, but I like to, somebody says something and it's new to me, and okay, I'll check into it. Sometimes people, they're just wrong. There's that old joke, well, if you read it on the internet, it's got to be true, right? So always double check that. But this is it. And again, these are kind of the macro trends. A dollar doesn't mean day to day. When the dollar goes up and down, gold will always move inversely. But overall, that's a big trend. Again, this is the US dollar down here, US dollar index. And then dollar peaked there, had a little drop. Gold rallied because of it. Again, this was the bigger trend when the dollar was rallying. And then it bottomed here and started moving up. There was an uptrend in the dollar, and gold certainly rocked right there. Remember, it had a breakout as well, which we got in. We're already trading it here, and then we went all in hard at 130 when gold or GLD broke out 130, which was right there, that breakout. Dollar fell, gold fell, right? You get it now, right? So dollar rallied, or gold rallied while the dollar was rallying. There was a little disconnect here. This was the last bear market, a lot of selling pressure in gold. What was happening, we were in a bear market in the stock market in 2022, right? And what tends to happen is margin calls, something called margin calls, where at the end of a bull market, which the stock market had just completed, in one of the biggest bull markets in history, one of the hottest runs after COVID with all the stimulus, you get excessive leverage in the system. You can Google the chart, NYSE margin interest, and there's charts out there that show you, and those peaks, they tend to go parabolic in the end of a bull market. And that's everybody buying on margin, because after a while, stocks are going up, and hey, I got to, my 100 grand turned into 150, 200 grand, whatever your number is. And so why not? Now I've got 200,000. My broker will let me buy. I've got $200,000 of stocks, but my broker will let me buy 400,000 on just regular Reg T margin, or I can trade futures and juice that up to, a couple million. And that's what tends to happen. And then what happens in reverse, when the bear market finally comes, those folks start getting margin calls. So they sell not what they want to sell, but what they have and what they have to sell. So a lot of that's, gold and some other things can get sucked down and sold out. And that's what happened there. But you can see since then, there's where the dollar peaked, fell, and it's not mere coincidence. So I think I did a pretty good job of explaining that correlation there. So now where do we go from here? I don't have a strong opinion. I've been listening to folks that know the Forex market and the dollar better than me. I'm reading a lot. And boy, you get such a divergence of opinion. Some talk about our skyrocketing government debt. We have the biggest debt to GDP ratio in peacetime history ever in the United States, meaning the only other time our debt to GDP ratio was this high is in wartime. And we haven't had a lot of like the real wars. So it's crazy to think that. So that's the dollar bears are going to say that's unsustainable. The U.S. is going to, the dollar is going to pay for that. See, but the thing that, okay, so there is that case, and maybe that plays out. But on the flip side is, number one, remember, the dollar is not the dollar in a vacuum. What the dollar is, or what gives the dollar its value and what makes it go up and down in value, it's relative to the other currencies. So in other words, it doesn't matter if you're in bad fiscal shape as a country, the U.S., all it matters, are we in better fiscal shape than the other countries in that basket. And so, but here's the thing, guys, we don't have to worry about the loonie, the Canadian dollar, or even the British pound, these big currencies. All that matters is the way the dollar index, it's just like always, kind of make sure to point out QQQ is not a diversified index. It's, Nearly half of the returns come from the Mag 7, if not more. I think it's whatever it is. Same thing with the dollar index. The euro makes up, and it has for years, 57.6 weighting. So, and then that pales to the second largest is the yen. And the yen is a distant second at 13.6% weighting. So there it is. So those two collectively right there, what is that, 70+% in just these two. But again, the euro dwarfs the yen. So the euro, it doesn't matter where the rest of the world's currencies go. So then you got to look at it. And I just wanted to say that's what matters. So if the proverbial shit hits the fan in the coming years here, obviously if the U.S. goes into recession, the world goes into recession. I think we can all agree on that. History has shown that. So then the thing is it going to be worse here, or is it going to be worse in the Eurozone? And so we'll let you guys decide there. And so therefore, the case I've heard that we could see a pretty strong rally in the dollar. In fact, a very strong rally, I've heard the case made. I've heard it both ways, but I'm kind of leaning towards that based on the charts and everything else. And so therefore, therein lies a problem. Gold's always been a flight to safety asset, and maybe you've got now its big competitor, Bitcoin. Bitcoin just got the SEC approval yesterday for to wrap up Bitcoins and start selling in ETFs. They didn't want to do it. The courts pretty much forced them. If you read up on that. But either way, so now gold has a more legitimate competitor, because that helps to to make Bitcoin more legitimate for the bigger firms out there and other institutions that before couldn't touch it because of its speculative nature. So now it kind of has that endorsement. If it's not a endorsement, if you will, but a quasi endorsement, whatever you want to call it, backhanded endorsement. You probably read the comments the SEC came out with. So okay, so there's that. So that maybe takes away a little bit. There's certainly an alternative for what was the previous alternative investment, a flight to safety thing. And then again, if the dollar goes up for the reasons I said, I showed it clearly on the chart over here. Right here, right there, and I clearly showed. So that's it. And so what I'm trying to tell you is I don't have strong convictions. I will recognize a breakout for what it is. I may take that breakout, and I'm speaking longer term. But the thing about it, guys, and please hear me. I talk for years. I've been talking about the next big drop in the market, the next big correction, recession, whatever is coming there. I don't trade that. I thousands of trades a year on the NQ and RTY, the small cap futures, and occasionally ES, and why I might be singing the bearish song long term like I am now and have been for a while. It doesn't determine my positioning, even in the longer term swing accounts. Even those, when the opportunities or in the charts they cover, we're going to rally. I'm not going to ride out. If I put a high probability on a 10+% a double digit rally, and it looks really good, and charts say we're going to bounce, I'm going to ride that out on my any short positions. I'll go long there. And so the same thing, what I'm trying to get at, same thing with gold. So I'm giving you my longer term view because it's been asked. And it, and this goes into formulates how I might trade. If we get the breakout, again, a breakout's a breakout until unless fails. But if that breakout fails, I'll be looking at things like the dollar to determine, hey, do we want to short gold? Because I'll tell you, everybody and their brother is going to be. There's more gold bugs than any kind of. There's a lot of perma bulls out there for the stock market. Always have been, always will be. But there's a certain subset of gold bugs. And then you're going to have everybody else, and they're going to bring out the cheerleaders on TV, and talk about the breakout in gold. So I imagine it's going to look like the real deal initially, and it may end up being the real deal. But if it fails, same thing I've been talking about bonds lately. I was before the herd recently. We were long and bullish, and I made a very strong bullish case for bonds. But now that's such a crowded trade that the technicals are still there to support it, in the intermediate term. But, I just have a feeling that the market's not going to let everybody be right on the bond trade. And so we may zigzag here and have another thrust up. And the same thing where I'm going with that is gold. If everybody starts getting foaming at the mouth bullish on if gold does break out anytime soon, the charts tell me there's a good chance that it could fail. I'll continue to give you updates. A lot of whether or not the breakout's going to fail or burn through the divergences to me will be determined by how the dollar and the euro looks at that time. Okay, enough on that. Okay. Quick update on natural gas. And quite a bit of comments. I've answered and given my thoughts in the comment section. This was T7 hit the other day. Potential and final target T8, at which we just a beautiful, perfect tag of that, followed by a pullback. It was asked when we hit that. I said, look, it could probably go up to here or here, max, and then pull back. So it was a great shorting up. Yesterday, I highlighted it. Was it here or here on this level? What is that? I don't know, 15%. Beautiful bounce trade. And then we hit that level again. And somebody asked, and I said, look, I took it there. That was a 14, almost 15% drop, and sold it now because we hit this. Remember, this is a big, big resistance level, very well defined. By the way, these are the Febs. I'm in the March now. But then boom, that was a great, if it was resistance before, if I called that as resistance back here before we even got there because of this, that 110% further validates that as a significant resistance level. So we had another punch up. And as I said, it's probably going to take nat gas a little while to consolidate, digest the recent gains before it can punch up through there, and then that'll be bullish. But I'll get to the March in a second. So either way, there was another great, reversal opportunity there. But we are on the March contract. Well, you can still, these are still trading, the Febs, but there's more volume, I believe, in the March right now. They've already rolled. So this is what the March looked like. And you've got this uptrend line right here. Let me change that color back to this light blue. There's a downtrend line off the highs. So we're pinching this triangle. That's that comparable resistance level that was T8, the final target on the Febs. And then boom. So ultimately, if we pop this, just might kind of grind around for a while before then. And then there's crude oil. Crude took out that downtrend line I was highlighting yesterday or the day before, whenever that is. Popped it and is back testing, so that gives an objective entry for crude. If it goes a little lower, you still have this uptrend line, which would also provide an objective entry. And that would take us up to T3 and then ultimately T4. Like I said a couple weeks ago, it was last week or the week before in the video, when I made the fundamental bullish case for crude and nat gas. I said, look, I didn't mean to be, I still don't mean to be insensitive to everything that's going on over there, but everyone's just trying to blow each other up in the Middle East. You've got the rebels firing at ships in the Red Sea, ships being diverted, and anyway, I just think that the risk premium is not being priced into crude. But again, at the end of the day, don't fall in love with it. It's not taken off yet, relatively speaking, really taken off. In a break below, there's going to be bullish. But again, you got all these previous reaction lows. Right now, just like gold I covered earlier in the video, you had this series of lows, but you still need to take out these highs. That's where it'll really rock, I think, over T3 and then T4. T4 is big resistance. That's an area I can just tell you now, and we'll roll these too. I'll mark up the March contract soon, but to get up there, that's big. That's comparable to that natural gas resistance. So it's a natural target. It's been T4 for a while, since back here. And those are where we went long back here. Off that divergent low, I think, hit T1, hit T2, almost hit T3. So that's the upside in crude, which is, better than, another 10% or so if we get that. But again, don't fall in love with it just because there's, missiles flying and everything going on over there. It doesn't guarantee that anything must or will happen to crude. Crude is, like currencies, the dollar and the euro. Crude is a highly manipulated security. A lot of it is, we got an election year, so you got the current administration obviously pressuring, and they have been, and the producers have been pumping, increasing production under pressure from the Washington. And then you got the Saudis and the and the Russians and everything else, where a lot of oil is being pumped. So yeah, with that being said, I still like it. And again, it's a way to diversify, if nothing else. All right, let me try to think, what else have I not covered? My outlook on the equity markets, and not just, it's the technical case is still there, divergent high on the 15-minute chart, still coming on. We're still below that divergent high, and with the wedge break. Remember, we had the sell signal 1 here, T1 hit, marginal new high, sell signal number 2. T2 has yet to been hit, but we had to truncate that short trade because we had that positive divergence, and we had support on the 15-minute chart and everything else. You can see it right there too, that reaction high. So still leaning that way. And again, it's not even worth covering the big fangs right now because we're so far above those key purple support levels that are kind of that all-in moment. And what else? Okay, yeah, I knew there was something. Somebody asked me the other day, hey, Randy, semis are a big part of the Nasdaq 100. Can you include them more often? Yeah, and it's been a little while. Let me update it here. So just like QQQ, we're coming off that divergent high right here. This is a 60-minute chart, by the way, guys. Coming off a divergent high, moving lower. Daily chart, nothing has changed in my outlook or positioning. There's a big divergent high recently, and you can even see that smaller. This is that smaller divergent high right here is what I showed you on the 60, but it also carries through to big divergent high on the daily, even the weekly chart. And I've covered these. I did an in-depth video just recently. Maybe it was at least this December 14th video, and I think I might have did one after. And I'm looking for a big drop. And again, I'm probably, I would love to know if there's anybody that ever, out there. I usually have kind of big, sometimes I'll call much bigger moves than most that are even bearish. I'm looking for the semis to, as of December 14th high, when I did that video, to drop about 52% over the next 1 to 2 years. And I'm leaning towards over the next year. And I know that's heresy among NVIDIA bulls. I've heard the feedback. NVIDIA won't stop. It's got a divergent high. And it's just, look, that's my read on the charts. Take it or leave it. You don't have to trade it. I have a pretty high degree of confidence. We're going to drop and we'll hit that next target, which was still unhit from last. That was when I called a top here and gave you 2 targets right there, T1 and T2. And we reversed a little shy of T2, so maybe close enough to consider it tagged. However, doesn't matter what I was thinking back then. What matters is what it looks like today. And so the same divergence that we had at that point, it's been building. We made a virtually an equal high, maybe even a slightly marginal new high. And so, that would be really based off that call. We didn't go out. If you look at it from an RR perspective, if you were swinging down, you said, okay, I'm going to take that trade, Randy. I'm going to try to get that, T2. And you shorted there when we had their sell signals, whenever it was, then you're just back to where you started. You certainly didn't exceed any reasonable stop. If you're targeting, a 50% drop, you can easily give yourself a 15% stop loss, and that's better than a 3-to-1 RR. So again, you can look at it, frame it that way. Not that I or anybody on the site has probably been short that whole time, because there were many reasons to cover and go long along the way here, as highlighted when the market hit targets, and Apple and Amazon and everything else. Those are the things I factor in. The semis aren't going to go down 50% without Apple and Tesla and NVIDIA and everything else dropping that much. But that's what it looks like. There's SOX. Remember, SOX is only one of 3 main. The ones I track are SOX, SMH. That's the Van Eck Vector Semiconductor ETF. Same thing, big negative divergences, just like you had the negative divergences heading into COVID, like you had them back here. And this is a weekly chart, guys, by the way. The weekly chart, just kind of paints a bigger picture. I don't like that trend line. And so, before all said and done, this is where, at minimum, I think they're going down here. This longer term trend line, 97-ish down to about 88, I think is a very reasonable target. And that's, again, going to be a pretty healthy, about a 50% drop. And then there's XSD. And so that's how that one looks there. The divergence here on the weekly as well right now. And then you can jump down to the daily chart. These guys all have. SOXX is the one I typically will trade and chart because it tracks the Philex SOX semiconductor index. It's been around forever and a day, the original semiconductor index. But you can see here support around 207. Anyways, coming off this divergent high right here, and semis have been moving lower, and I think have a lot more downside to go. And there was SMH as well. There's big divergence here, building, little kickback rally. And the difference is they have a different basket of semis. They have obviously a lot of overlap, but they have some have different stocks than others, and they all have different weightings than others, the other semi ETFs. So that's that. There's that update. And again, get a little granular, go down to the 60-minute charts, and you see that divergent high. You can see I could put a resistance line right here because we just bounced back. Why did I put that? You had support, several candles right there. And then more recently, some resistance right there. There is a gap if it wants to try to fill it. Remember, QQQ just filled that gap and then had a brief opening spike and then got faded out and reversed off it so far. Let me see if I can put a trend line that might come into play here. Yeah, you've got enough reactions, 1, 2, 3. So there it is. That should do the trick for the next sell signal. And then I haven't updated this chart in a while. Minor support there, but I think would come down in the near term before a bounce somewhere here. Let me drag that line. I'd have to remark this up. These are old targets. This is the last short trade was there, a divergent high. T1, must have had T2, two targets. And there's an example. We hit T2, and then we put in a divergent low, and that's why the semis rallied. And now we have a divergent high, and so now we probably go down. Alrighty, long video, but I'll wrap it up here. Remember, everybody came into the year foaming at the mouth bullish, and I'm speaking metaphorically generally. Foam at the mouth bullish on 2024, and it's been nothing but so far we're down from day one. Came out of the gates swinging, on the short side. Most everything is reversed. This is right there. There's the month break line right there. Semis are down. Market's down. Yields have ticked back up. And, we'll see, guys. All right, my thoughts. And if you missed anything or you want anything else covered, post a comment. I'll try to get to it and either include it in the next update or I'll reply to your comment. And I'm going to pick it up from there. I'm going to keep hunting for trade ideas, see if I can find anything else for you. But I'll just kind of leave it here. The VIX is starting to look interesting again. I've highlighted a few times recently. So far, the market can't get out of its own way since the start of the year, but the VIX just keeps inching lower. This is VXX, VIX short-term VIX futures. But spot VIX is just looking ripe. It's a spot VIX. And spot VIX, by the way, the VIX did peak right here in December and has been moving higher. Let me be very clear on that. Those VIX ETNs are, I don't want to call them garbage. You just got to get in. You can't get in early. You got to get in at the spikes. Your timing has to be impeccable when trading the VIX, especially those VIX ETNs, because they just suffer from decay due to their expenses. I personally trade VIX futures over the ETNs, but that's it. This is a spot VIX. So when you want to know what it needs to do, it's been making lower highs so far, lower lows, and you've got nice resistance there at about 1426. So maybe set a price alert. If the VIX pops that will most likely coincide with a drop in the stock market and a spike in the VIX. And that's just a 60-minute chart. Long term, still at this long-term key support zone right here, which I highlighted in the last few videos or over the last few weeks. Divergent low at key support, big support zone. And I know I covered that in one of the recent videos. These are all potential targets, including but not limited to this downtrend line. So if we can get some traction to the downside, and we could see that. Otherwise, we don't. That's it. So trade, line up. If you want to really make money in time, you trade the VIX. If you don't know what you're doing, stay away from the VIX. But otherwise, wait for breakdowns in the market. Wait for the S&P. wait for Apple, wait for QQQ to give you some pretty good sell signals, especially if the VIX hasn't yet priced that in. Those are the moments to jump in there, and then the VIX can spike up. And again, just don't get married to it. It's just like natural gas. This is a widowmaker. Natural gas is a widowmaker. If you stay too late to the party and the trade's going against you, it can really inflict some damage in short order. So again, my advice, if you don't know what you're doing, stay away from it and just stick to trading the equity markets or something like that, the ETFs. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.